Hello friends, welcome back to Elf Crypto. We're continuing with the second part of the PDF on market structure and powerful setups. We've reached chapter 4, and I want to talk about order blocks. Order blocks are candlesticks where market makers or banks place their orders, and the market returns to those candlesticks. If these candlesticks are truly order blocks, the market will always react to them. We have two types of order blocks, bullish and bearish. What's the deal with a bullish order block? A bullish order block is the last bearish candlestick before an upward move that breaks the market structure. This is very important. The second important point is the break of the market's higher structure. It's not just about identifying an order block. The momentum that follows the order block should also create a break in market structure. Make sure to pay attention to this, guys. In such cases, there's a high chance that when the price returns to that bearish candlestick, it will hold and push the price back upwards. An example would be like this. A red candlestick appears, then an upward move follows, though it's not necessarily that big. And then the next candlesticks are green to show what an order block looks like. The momentum causes a BMS to form, and this is where we say that this order block was responsible for propelling the price upward. Next time, there will be some orders from the banks within that block, and we can enter the market as well. If we couldn't identify the entry at the initial candlestick, we can definitely enter in the retracement zone. Why? Because banks would never let their stop losses get hit in areas where they've decided to push the price upwards. So, you can confidently consider the area below the order block for your entry. The chart also provides an example with a red candlestick. An SMS has also formed here, and a strong momentum has occurred after a small range, followed by another swing that breaks the stop. Upon the market's return to the order block, there are still orders, and new orders are placed. This bearish candlestick is our bullish order block. Now let's discuss the opposite, bearish order blocks. A bearish order block is the last bullish candlestick before a downward move that breaks the market structure. There's a high probability that when the price returns to this bullish candlestick, it will hold and push the price back down. The next example visually shows what happens in the market. We have a bullish candlestick, then momentum causes the price to fall, breaking the final support swing low. This is when we can enter in the retracement zone of the order block, with a stop above the high. An example would be an order block that formed after strong momentum, and in the retracement zone, we look for entry points. Some traders set limit orders right at the candlestick, while others look for entry signals in lower time frames, as explained further in the PDF. Remember, a daily candlestick contains several lower time frame candlesticks. For example, a 1-hour chart has 24 candlesticks, and a 4-hour chart has 6 candlesticks that can form a daily candle. So keep in mind that each candlestick has an open, a range low, a range high, and a close. In general, a daily range consists of an open price, a daily low, a daily high, and a close. Here you can see bullish daily candle on the left and bearish candle on the right. Let's move on to the next topic, the sweet topic of sessions. A daily range includes 3 trading sessions: the London session, the New York session, and the Asian session. During the Asian trading session, due to the lack of liquidity in the market, the price fluctuates between 20 and 40 pips, which is a consolidation period. This is an Asian range. As you can see, the movements it makes are very small, around 20 to 40 pips, as previously mentioned. It's also explained here with examples of Asian range movements. The exact time for the Asian session has been specified from 2 a.m. to 8 a.m. Now, let's talk about the London session. During the London session, usually the daily high or low is formed. Due to the liquidity available during this session, traders might place trades in the opposite direction to the market's movement. Regarding the sweet topic of liquidity, pay special attention to the first 2 to 3 hours of this trading session. For instance, if we take the time as UTC plus 2, it would be from 9 a.m. to 11 a.m. or 12 p.m. Some people say that the most significant movements happen in the early hours of these sessions, although the London session doesn't end at 2:30 p.m. As you may know, London extends until 5:30 or 6:30 p.m., and then New York opens 3 hours later, and London finally closes. You can see the chart example here for the London Open. By LO, we mean London Open, or the open price of the London session. Here, the daily low is hit, and then the market moves upwards. After that, New York likely starts. You can see Asia, London, and New York sessions marked here in a schematic example showing stop hunts. This refers to the tricky swings which usually happen during the London session. Moving on to the New York session. During this session, the price often retraces from the high or low set during the London session. In some cases, the daily high or low can also be formed during the New York session. Again, focus on the first 2 to 3 hours of the New York session, as that's when most retracements happen. According to the PDF, the New York session is from 2 p.m. to 4 p.m. UTC plus 2. In this example, the high of the London session is taken out, and the price continues upwards, passing the Asian range and performing a stop hunt. The low was formed earlier, followed by a correction towards New York. Now moving to the next section, Accumulation, Manipulation, and Distribution, AMD. The PDF explains these concepts one by one, so I'll summarize them for you. Accumulation, or the gathering of positions, usually happens during the Asian session. The characteristic of this phase is that the price doesn't fluctuate much. Manipulation usually occurs at the beginning of the London session, though sometimes it can happen at the start of the New York session as well. As a result, during the manipulation phase, the price moves in the opposite direction before resuming the main trend for the rest of the session in distribution phase. The goal is to trap traders. For example, in an uptrend, the price might make a small downward move, making you think it's going to drop. Traders enter a sell position only for the price to resume the uptrend, continuing its original direction for the rest of the day. This manipulation happens when market makers exit their positions, either closing their buy or sell orders. The daily range, as mentioned earlier, plays a role here, manipulation, and then the continuation of the trend. Now, let's look at a schematic example. If we consider the 15-minute chart, it represents one daily candlestick. At first, the price goes down, then up again, forming a shadow. Manipulation occurs in a downtrend, pulling traders into the market or triggering their stop losses. After that, the main movement continues, representing a day's price action. The Asian session starts, then manipulation happens in London, pushing the price up. Once the manipulation ends, New York begins, creating a similar pattern. You get the idea. In this case, the low of the London session is pushed up, and as it reaches its peak, then exits. The bullish candles formed here turn into bearish ones as the buying pressure turns into selling pressure, leading to a correction. A similar example for a bearish AMD is shown here, with a range forming on the opposite side followed by distribution. In the Asian session, market makers or banks, due to liquidity, buy below the open price of the Asian session or sell above the open price. When the market breaks above the Asian session range, they sell, and vice versa. They buy below the range. Moving on to the powerful setups. Some have criticized the translation, but as the book states, a turtle soup setup is like a price move designed to neutralize liquidity, which in this case means stop losses. It represents a fake breakout above or below a liquidity area, a common occurrence in the market. TSS is a trading setup for taking a short position after a fake breakout above a liquidity area where buy stops are activated, while TSL is the opposite, for buying after a fake breakout below a liquidity area. Typically, prices fluctuate between 5 to 20 pips above or below the point where liquidity is present. Once the price reaches that liquidity point, you can enter a trade in the opposite direction with at least a 10 pip stop loss. For example, if a buy stop liquidity event happens in a turtle soup setup, you should take a short position. If it's in a turtle soup long setup, you're looking to buy. Here's a schematic example. If a BSL event happens and stop hunting occurs in that area, you can enter a trade with a stop loss 10 pips above the highest point where the stop hunt occurred. Now let's consider the next example for TSL. After breaking a low and triggering stop losses, price moves in the opposite direction, and you can enter a long trade with a 10 pip stop below the stop hunt area. Next part is a 3-part setup which is known as BMS followed by RTO. Here's how it works. First, a stop hunt occurs which is used by market makers to neutralize liquidity. Next, a break in market structure confirms the setup. Finally, price returns to the order block and you can enter the trade. Market makers place their orders in these areas, and because of the high volume, price can't easily break through these zones. If price revisits this area, it bounces back sharply due to the strength of the orders in the block. In the bullish example, after a stop hunt occurs and the market structure breaks, price returns to the order block, and the block propels the price upward. Next time you'll see it for yourself. Here, you can see that there was a stop hunt, the structure broke, and it's getting ready to turn bullish and reverse. So you just wait here to enter the trade and place your stop below the low. Here's a chart example. The market went up and it formed an order block. Then it came back down, but you can see it reacted. This reaction happened because the market aims to consume and gather liquidity. When we're looking at charts, it doesn't matter whether the market moves one way or another. The key is identifying where the stops are. For instance, once the market formed a low, moved up, and the next day it formed another low and then moved up again. What will the market do next? It'll continue upward, targeting the buy stop liquidity. The buy stop liquidity often gets triggered, and you shouldn't worry. Why should you? If you've entered here with the right mindset, knowing that the market intends to move higher, be assured that the market is looking for liquidity where stop losses are located. Now, this larger movement was triggered because it was a higher time frame, and you can see the candle is bigger. So it means the stops from higher time frames were also taken out. For example, this is a 15-minute chart, but imagine if it were a 1-hour chart. The swing would have been smaller, and a small candle could have been enough to take out the stops. Afterward, the market continued upwards, and we should stay patient to understand what's going on. After understanding these points, we'll be able to comprehend the market without much trouble. Here's a schematic bearish example. The market formed a bullish candle, broke the structure, and entered again at the RTO, which is returned to order block. That's it. Moving on to the next example for a short position. We have a high, an equal high, and two peaks next to each other. The market performed a stop hunt and dropped. After the BMS, price returned to the OB, and that's where you enter the trade. If the range is large, it might not give you a clear zone, but it still returned here, and this became the first target. Given the price action here, we can assume that after hitting the stop, price will move down quickly. After it reaches here and takes out the stops, the market will likely continue down, which is fascinating because it becomes easier to analyze once everything has played out. Okay guys, let's explain SMS. When price fails to break a previous high or low, it signals the end of the trend and a reversal may occur. I've already explained SMS in detail before. How do we trade it? First, price can break the high or low ahead of it, which marks step 1. Then, a break in the market structure happens, confirming the setup. Finally, price returns to the order block, allowing us to enter the trade. In the bullish example, price forms a high and an order block is created. We can't know there's an order block until the structure breaks. Once it does, SMS occurs, signaling the reversal. After the break, price pulls back to the order block and we can enter a trade. In the bearish example, an SMS is formed, indicating weakness in breaking higher highs. Price forms an order block, which leads to a BMS due to momentum. The chart example shows this clearly. SMS, BMS, and a pullback with momentum for entry. Now let's move on to the topic of accumulation. In the accumulation phase, price moves within a range and is manipulated in the opposite direction. You can find stop hunt, BMS, and RTO here. Sometimes price rises and you'll see a small BMS. You have to accept that the book illustrates this scenario. A gap has formed between two shadows, which hasn't been filled yet. Price broke below, triggering a stop hunt, and after the break, it returned to the order block, which was the origin of the move. After the stop hunt, price moved up. And keep in mind for bearish AMD, it is exactly the opposite. Well done. If you enjoyed my video, I'd really appreciate if you hit the like button and subscribe for the following sessions. Thanks for watching and see you next time.